All right, so welcome to Module 1 of Managerial Economics. So we're going to start off a little bit in an interesting way by looking at macroeconomics. So for a lot of the class, we'll be looking more at microeconomics. So microeconomics focuses really on two groups and how their decisions play out in a market. First group is consumers. Second group is producers. So consumers would be individuals, households, as they try to decide what to buy with their limited budget. Or you can think about how they try to decide what to do with their labor in terms of job market decisions. And then on the production side, we have firms, which relates to us as we think about managerial decisions. And so firms are going to try to figure out how to take on costs in the most efficient way to produce valuable output that consumers are willing to pay for. And if you combine the two, you get market outcomes. In micro, we're usually looking at specific markets for a good or service. So maybe we're looking at the market for restaurants of a certain variety. And so you have the restaurants, the businesses, and then you have the consumers. And then as both sides respond to their incentives in a market where we sell this good at a price, we're going to look at equilibrium outcomes in terms of how much is produced of a given good, what price is it sold at. That's really microeconomics, and of course this is going to have a big impact on business decisions. But we want to start off by looking at macroeconomics. And so macro is really just about the economy as a whole. And so what is the economy? It's really just our whole system of trades. You have a whole bunch of different markets. You have the market for each good, each service, and the whole economy. And then this whole complicated, intricate ecosystem of all these trades we make across these goods and services. Maybe you could look at the U.S. economy. We might even want to look at the whole global economy as we think about business decisions. That's really what macro is about, about how all these complicated markets work together to shape our whole economy. All right, and so we could think about a few things when it comes to how macroeconomics and business decisions are related. One, how do the decisions firms make shape the macroeconomy in terms of investment into producing different things? We invest in capital, which allows us to produce more stuff. We try to figure out which are the best investment opportunities. And of course, that's going to shape how productive we are overall as the economy if we make the right investment decisions. And then how do macroeconomic factors shape business decisions? That's kind of the other key part of it. So as we understand what's going on in the overall economy, that can help us make better business decisions. All right, so each module will have some learning objectives. Here's our 5 for this week. If you look at our learning guide, the first one is to discuss the purpose of business from an economic and Christian perspective. So for that one, we'll have a reading reflection that you'll look at a few articles and discuss things with your classmates. These next two are related to chapter 17 in a textbook by Jones. There's a PDF provided for this chapter. This is focusing on investment decisions. So how much do firms want to invest in capital or tools that allow us to produce more stuff as a function of the expected returns to capital and the user cost of capital. And then we want to understand how these factors are going to affect a firm's stock price. And then if we look at chapter 13 in this Jones book, which also has a PDF provided, we can look at aggregate demand, aggregate supply model, how that helps us understand short-run fluctuations in output and inflation, how that determines what's going on with business cycles and what's shaping the economy. So this is important for us to understand as we manage businesses. And then we want to understand how stabilization policy can be used to try to offset demand shocks and stabilize both output and inflation. So if you look at the news and look at things like Fed policy, what's going on with the Federal Reserve Bank, we're going to raise interest rates or lower interest rates. How is that going to affect what's going on with inflation and economic growth and unemployment in the economy? These things are all important to know as we try to understand the system that we're a part of and how we can make wise decisions within that system. All right, for each module, this is looking at module 1 here, we're going to have some items that are due on Thursday night at midnight and some that are due Monday night. And so focus first on the ones that are due Thursday night. You'll watch this video as you're doing now and respond to a quick question there. Then we'll look at this introductions assignment where we'll introduce ourselves a little bit and get to know each other a little bit. Then you'll have to schedule a time to meet with your small group later this week to end the module. And so each week, most weeks at least, you'll meet with a small group of 3 or 4 people, and you'll have a discussion guide that will help you help each other learn. So whether that's looking at homework or the chapters that we cover in the book, maybe it's looking at the reading reflections, there'll be a discussion guide, and then you'll submit a link with that Zoom video, and this also is a way for you guys to collect questions that you guys can submit to me if there's anything that's confusing. All right, you'll read this article and participate in this reading reflection on the purpose of business. And you'll also pick a podcast to listen to related to a macroeconomic subject of your choice. And you'll submit a short report to the rest of the class. And then in addition to these small group Zoom meetings, so most weeks we'll have just a meeting on Zoom with your small group. Other weeks, just 2 of these 7 weeks, we'll have a Zoom meeting with the whole class. And so to help us schedule that, right away I want you guys to fill out this survey to help us find one time to meet at the end of Module 3, another time to meet at the end of the semester at the end of Module 7. All right, and then for Monday night, you'll look at these chapters in the book and some homework problems. These will take some time, but you can kind of see here there's some time allocated for these things. So you have to go through the book. I'll try to give you a little bit of an overview here at the outset, but let me know if you have questions about anything in these chapters and then these homework problems as well. You'll also have a chance to kind of discuss these with your small group here. And then the last thing you'll do is this data exercise. So hopefully this won't be too bad, but this is a chance to look at some real data on what's going on in the economy and to understand what some of these measures are and how they're evolving currently in the U.S. All right, so that's kind of the setup. If we look at chapter 17 in Jones, we're looking at investment and how that relates to businesses and what's going on in the overall economy. So the first question is the optimal level of investment in capital for a firm. All right, and for capital, we usually use the letter K in economics. Now, for any question where we're thinking about how much, the answer is basically always you want to find the quantity of something where the marginal benefit equals the marginal cost. Now, the reason for that is usually as we're choosing more of something, the benefit of an additional unit is going down the more we already have. So the marginal benefit is the benefit of an additional unit of something. Usually the more we have, the less benefit we get from an additional unit. So if the marginal benefit's going down and the marginal cost is flat or increasing, meaning that usually it gets more and more difficult to accumulate more and more of something. If that's the case, then we want to keep going, keep choosing more as long as the marginal benefit is greater than the marginal cost. And then the stopping point is going to be our optimal amount where marginal benefit equals marginal cost. So we're looking for the quantity where marginal benefit equals marginal cost. That's the marginal decision rule that applies to essentially everything in economics. But when it comes to how much capital we want to invest in, we can use this rule. So what is the marginal benefit of getting an additional unit of capital? Well, we're going to assume that the price of whatever we're going to sell, whatever we're producing, is equal to 1 to kind of simplify things. But the basic idea is that we want more capital because it helps us produce output. And how much output can we produce with 1 extra unit of capital? Well, that's going to be what we call our marginal product of capital. And so if we produce some more output with our additional capital, we want to know how much does our output go up? Y is our output here. And so what's our change in output when we have one extra unit of capital? As we accumulate more capital, we look at our change in capital, we look at how much more output that gives us. That's our marginal product of capital. So the benefit of getting more capital is you produce more output and you can sell it and gain revenue and profit. The cost is based on a few things. We'll call this the user cost of capital. And so there's a few parts to this. The first one is the rental rate of capital, or we call this just the interest rate. And so we either have to borrow money to buy this additional capital, or even if we aren't borrowing it and we just have cash on hand, we're foregoing the opportunity to rent this capital to someone else at whatever the going interest rate is. And so part of our cost of capital is this interest rate. The next part is what we call our depreciation rate. So D, a little line over it, is our depreciation rate. So part of the cost of this capital is that it's going to wear out. So if we get 1 unit of capital, some fraction that's going to wear out over time because whether it's a sewing machine or equipment or machinery or whatever, it wears out over time at a certain rate, and that's part of the cost of capital. But one thing that's going to help offset the cost of capital is any capital gains. So this is delta for the change in the price of, the price of capital. So this here is our capital gains rate. This is how much our asset is gaining value over time. So if we buy this asset that allows us to produce more stuff, or capital, it helps us produce more stuff. This is how much more stuff we can produce with an extra unit of capital. So that's the benefit of an additional unit of capital. The cost is whatever the interest rate is plus the depreciation rate minus however much this asset is becoming more valuable over time in price. Alright, so that's our first question. The next question is going to be related to the stock price. So we're going to have a simple model in chapter 17 of the book here. And so our stock price, we're going to try to model based on the condition we call the no arbitrage condition. This means that if two investments have the same level of risk, they should have the same level of return. So if you have two different assets, if they're equally risky, they should have the same return. Otherwise, everyone would buy the asset that has higher return until the price is bid up and the return comes back down to a normal level. So let's say you have a certain amount of money that you could do two things with. You could either put it in the bank, or you could buy stock in some company. And let's say that the price of buying 1 unit of stock is PS, price of the stock. So what's our return if we put our money in the bank? Well, we either buy 1 unit of stock for this price, or we take that same amount of money that it would take to buy 1 unit of stock and we put it in the bank. And if we put it in the bank, our return is this amount of money we put in times our interest rate that we get if we put the money in the bank. Straightforward enough, right? So that's our return if we put it in the bank. And if there's no arbitrage, we're assuming, for simplification, that there's no risk in the stock market or putting our money in the bank. Of course, that's probably a hefty assumption. In reality, the stock is probably riskier. But this just helps us kind of get a simple model. So the return, if we put our money in the bank, should be equal to the return we get if we buy a stock. What's the return from buying the stock? Well, we buy 1 unit of stock and we get some dividend per unit of stock. That's the amount of money that is paid out to shareholders in the form of a dividend. And then we're going to have any appreciation in the value of the stock. So if we buy the unit of stock for this price, we could also get some return from the fact that there could be a change in the value of the stock over time. Any increase would add to our return from buying the stock. So we could divide both sides by price of the stock and see that this interest rate should be equal to dividend divided by the price of the stock, which we could call the dividend rate, plus the change in the price of the stock divided by the price of the stock. Okay, so this part is the dividend rate, and this here, like we saw just before, is the capital gains rate. Alright, and so if the interest rate when you put the money in the bank is like 5%, what we're saying is that if you add up the dividend rate and the capital gains rate for the stock, that should equal 5%. Otherwise, we'd have an arbitrage opportunity. And if investing in the stock had higher returns, everyone would just buy the stock and no one would put their money in the bank, or vice versa. So if the interest rate, if you put your money in the bank, is 5%, this dividend rate plus the capital gains rate would have to equal 5%. So maybe the dividend rate is 2% and the capital gains rate is 3%, or some other combination that gets us to 5%. Now if we look at this equation here, R equals the dividend rate plus the capital gains rate, we could move this around a little bit. So if we subtract this over here, we can have I guess something like this. Alright, and so now let's say we take this, multiply it over there, take this whole thing and divide it to that side. Then what are we going to have? We'll have the price of the stock by itself, so this will help us tell us what the stock price should be. It should be equal to the dividend divided by the interest rate minus this capital gains rate in percentages, which is how much the stock is going up in value divided by the initial price of the stock. And so here you see that the price of the stock, PS, should be equal to the dividend divided by interest rate, which is R, minus this capital gain rate. Alright, so that's the basic idea of the price of a stock.